Hello everyone. In this video, I will show you how to use our quantitative trading analysis template. First, download and install the script to export OHLCV data from MetaTrader. Then, drag the script onto the chart of your chosen symbol, or enter the symbol and period, or simply select the option to export all available data. Next, go to File, Open Data folder, the same steps we used when importing trading history into our Excel Pro Trading Analytics template. Then navigate to the MQL5 Files folder. Copy the CSV file to your desktop or any easy-to-access location, so you can later import it into the template. My data is already imported, but I'll still demonstrate how easy it is to import large datasets in just a few seconds. As you can see, I've tested multiple symbols and different time frames, and I recommend using H1 or daily data for the best results. Our script automatically detects the pip size of the selected symbol. If your broker uses a different pip size for a specific symbol, you can simply enter it manually. This ensures accurate and simplified calculations.
OK.
The symbol, time frame, data range period, and number of bars imported are displayed at the top, helping you avoid analyzing the wrong market or dataset. It's important to check your data first. Maybe sometimes you will get a missing data from a range period. Next, run all analyses one by one and click OK. This process may take 1 to 3 minutes depending on the size of your data and the performance of your PC. In the distribution analysis sheet, we calculate returns in percentage for every bar, open to open and high to low, generate descriptive statistics, and create histograms. This helps us understand how prices typically move and fluctuate, provides statistical basis for risk management, helps identify normal versus abnormal market conditions, etc. This is the same quantitative approach taught to first-year analysts at investment banks. It represents a fundamental first step in professional trading education, learning to understand market behavior and risk through data rather than speculation. The returns are divided into ranges, and for each range we calculate the frequency and the probability. This helps identify which ranges occur most often, providing insights into market movements, potential risk, and the proportion of positive versus negative data. In this sheet, distribution analysis is applied to open to close, high to low, and absolute open to close data in pips, with absolute values always positive, making it easy for any trader to gauge intraday market volatility. Previously, this approach was manual and time-consuming. Now, our Excel spreadsheet performs all analyses in just a few clicks, letting you study multiple markets and timeframes in an hour, far beyond the old daily data-only method. The session volatility sheet is a powerful analysis tool that identifies the most directional sessions, bullish or bearish, highlights the most profitable and volatile trading hours, pinpoints the best days for long or short bias, detects strong trends, and recommends the optimal strategy for each session. As shown for gold H1 time frame over this period from 98 to 2025, the Asian session is the most bullish and volatile session. Note, this session includes more bars because it also overlaps with the Australian session. The positive directional bias indicates a clear upward tendency, evident from gold's rise from $2,000 to $3,800 over the past 3 years. Now let's analyze the data over time to understand its relationship with price behavior. This includes identifying bullish and bearish tendencies by hour, the best days of the week for long or short bias, distinguishing strong trend days from quiet ones, and assessing monthly volatility to spot the most volatile months and potential seasonality or market cycles. For gold, the most bearish, bullish, and volatile hours are between 23 p.m. and 1 a.m., just after the Asian session opens. Note that the data time is based on the broker's server. We see that Sunday is the most volatile day, likely due to weekend gaps, and also the best day for long positions, giving traders a strong start to the week. The most volatile month is April, with an average movement of 1,593 pips. All trading analysis sheets include explanations, insights, recommendations, and interpretations, making it super easy to understand and act on the data. Next, let's explore another powerful analysis, volume and liquidity analysis. This uses real volume data provided by your broker. You can use more reliable sources for futures markets. With this analysis, you can identify the most and least liquid hours and days, examine returns by volume levels, and explore correlations between volume, volatility, and returns, helping you choose optimal entry and exit points for long and short positions. In the volume versus bars table, over 70% of the time corresponds to illiquid periods, while high volume periods occur much less frequently, typically around midnight and in the late afternoon. Illiquid periods should generally be avoided by intraday traders due to higher spreads and slippage, whereas liquid periods offer better spreads, execution, and sometimes lower volatility. Interestingly, average returns can still be quite good during illiquid periods. Thursday emerges as the most liquid day. High volume spikes often precede significant price moves, making them ideal for breakout strategies. Using the volatility-volume correlation, we also observe that the market tends to be particularly active and moves strongly between 2 and 4 a.m. After running the analysis, be sure to review this section of insights and recommendations, as it provides practical guidance gathered from years of trading experience and extensive data analysis. We also included a crucial tool for price action traders, identifying potential support and resistance levels, key areas where buyers and sellers interact and influence market direction. Our template implements two robust methodologies to determine these levels, deliberately avoiding the qualitative approaches often used by novice traders and instead applying a fully quantitative approach. Using the range division method, levels are calculated by dividing the historical price range into equal segments. You can choose a specific data range or use the entire historical dataset, adjust the number of levels to calculate, and you're ready to go. Now, with a single click, you can export these levels into a readable format, ready to be copied into the input of our free indicator, which will automatically read and draw them on your chart. You need to copy the content from column C for each group. Add the indicator to your chart, for example, a gold chart for me, then paste the exported levels into the input section, just like I do. It's that simple. Each group of levels can include up to 20 levels, and you can continue adding more level as needed. Then click OK, and the levels will be drawn on the chart. These are reliable levels, as the price often interacts with them, either reversing or breaking through, providing good trading opportunities. Now you can monitor these levels for manual trading, or use our trendline breakout EA, which can automatically trade based on the drawn trend lines. The second methodology uses volume-weighted levels to identify the most tested price zones. Levels are determined based on price clustering, areas frequently tested with volume confirmation. You can apply a date filter to analyze short periods. This process may take slightly longer than the first approach due to the additional volume-based calculations and filtering. Levels are sorted to display only the most significant ones. High volume levels indicate stronger support and resistance. By combining price action with volume confirmation, this approach filters out weaker levels, helping you focus on high-quality trading opportunities. Again, with a single click, you can export these levels into a readable format, ready to be copied into the input of our free indicator, which will automatically read and draw them on your chart. In MetaTrader, clear the old levels and replace them in the input section. This time, this method generates many more levels, up to 100 at maximum. These represent the most significant zones. To use them, copy each group of 20 levels into the 5 input sections, 20 by 20. One drawback of this approach is that it often produces several closely clustered levels. To address this, we added a filter that allows you to set a minimum distance between levels, with a recommended distance provided. Continue the process as needed. This approach doesn't capture the newest levels when the market keeps pushing to fresh highs, since those zones haven't yet been tested multiple times. That's completely normal. For this reason, I combine both methodologies, one to capture historical, tested levels and the other to identify new potential levels, to ensure full market coverage. I can generate levels only for the last year, or any custom period I choose, by using the average distance of market movement provided by the volatility analysis. Levels now are generated, then exported. Now, I'll simply copy and paste these levels into the empty input group of the indicator. Here we are. The combined methodology provides reliable levels by using both range division theory and volume-confirmed tested price zones. These levels work across all time frames, but only for the analyzed symbol. The same analysis can be applied to currencies, indices, commodities, crypto, CFDs, futures, and even stocks. The final analysis we've included, and plan to expand further in the future, is pattern recognition. It automatically detects major candlestick formations, tracks their historical success rates and average returns, and highlights the most effective patterns for your specific market. From over 23,000 candlestick patterns analyzed, doji and engulfing formations appeared most often, while dark cloud cover and bearish engulfing showed the strongest bearish reversal signals. In trading, what gets measured gets managed. Start measuring what truly matters. Thank you for watching.